Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Happy to be back with you again today. I'm your host, Dr. Alan. I know you'll enjoy today's show, and I have a big ask that will only take a moment of your time. Ratings and reviews are the lifeblood of our podcast. To leave a review and a rating, iPhone or other Apple iOS device users, go to Apple Podcasts or iTunes. For all you non-Apple device users, go to podchasers.com. On either site, search for Real Estate Investing Abundance. Once you find us, leave both a review and a rating. Subscriptions are also vital to the show's success, so please be sure to subscribe on your favorite podcast app. It's free to subscribe, and you can unsubscribe at any time. Enlightened investors, today's guest has been an avid real estate investor for over 15 years and is the co-founder of SMK Capital Management. SMK is an investment firm that provides investors with passive income and growth through the creation of partnerships in private commercial real estate opportunities. Let's dive in and learn how to achieve diversification and recession resistance with our guest, Mark Khuri. Mark, before we get into the business of real estate, share an experience from your formative years that helped you to be the person you are today.
Sure. Yeah. Thanks, Alan, for having me. Good to be here with you. An experience that pops up when you ask that question actually is probably pre-real estate investing for me. Maybe 17 years ago today, I was sitting in an office where I worked. I was a financial analyst working for big corporate America firm, about 80,000 employees worldwide. And we were on a project with a deadline. It was Tuesday night, maybe reaching about 10 p.m. And I was young, in my early 20s, and no problem, right? Working late, working hard, you got to earn it. But at the same time, one of my colleagues in the same room, probably about where I am today, give or take 17, 20 years older than me at the time, had been with the company for, maybe 20 years. And I just couldn't get over the fact that he's still sitting in that room with me at 10 o'clock at night, going through the project and the details and trying to hit the deadline. It was a bit of a wake-up call for me, Alan. That night, it just sunk home. It was almost like staring at your future self, potentially. And he was a very respectable colleague. I still, to this day, he was really good at what he did. And so I looked up to him. But at the same time, I also felt, I don't know that I want to be working at 10 o'clock at night with a 22-something-year-old, no offense, but after 20 years in the business. So that was a big turning point for me psychologically, strategically, where I started opening up my eyes to other options and potential career paths and started learning a lot more, educating myself on passive income, growth. Rich Dad, Poor Dad was a book I shortly read thereafter. And that kind of started my progress into where we are today in real estate investing.
You had this dramatic insight one night, and then the next day you're a real estate investor. I'm sure there's a gap there, and a lot had to happen in the meantime. Fill us in on that process of going from that insightful night to the first real estate investment.
Yeah, it got the wheels turning, right? I realized that entrepreneurial spirit in me was growing. And I went down a path of education and learning and trying to see other options. And a couple of years later, I transferred jobs and got another job with a different firm in operations management, logistics, fulfillment. Saw that company grow from about 5 million in revenue to almost 100 million in revenue. And along the way, I started investing in real estate on the side. I bought my first place. I moved into it. It was a 2-bedroom condo in Southern California at the time where I was living. Rented out the second room to a friend and helped cover all the bills and expenses. And I fixed it up every day after work, go to Home Depot, ask the guys that work there, how do I do tile? How do I do cabinets? How do you do paint, et cetera, et cetera. Learn by doing while still working. And also at the time, the market was going gangbusters, appreciation. And I just thought, hey, this is easy. It's been 2 years I've owned this place. Look how much it's worth now. I should keep doing this some more while working. And so I pulled out a line of credit on my place and used that money, partnered with my brother. We invested in a 4-unit apartment building in Hollywood, California. We overpaid. We bought it 25% occupied. It needed a good amount of repairs, but we over renovated it, and we took 6 months to renovate 3 2-bedroom apartments. And so learned a lot by doing. Again, that was after work, leave the office, go to the property, manage the contractors from A to Z, leasing, tenants, tenant management, utility, you name it. It covered everything from A to Z, loan, etc. And that's a bit how I got started. And by 2009-ish, the company I was with, Alan, just didn't really have much of a future anymore. The industry they were in was severely impacted by the recession. And so being at that firm and seeing how the economy could affect the business directly almost overnight, it was a very amazing and scary experience at the same time that still holds true to a lot of our decision making today. By going through that, you mentioned recession resistance. That's part of why we focus on that today. But we also we want to be able to persevere in all different economies and market cycles. And anyway, COVID has been a big test of that. We can talk more about that if you'd like. But that was a bit more of the early years. And I decided by 2009-ish to start my firm. My father and I decided to partner together. He's been a passive real estate investor since the 1970s and learned a lot from him, of course. And we started our firm to do what we had already been doing. We had started partnering, as I mentioned, as family members. We bought some properties at auction, primarily residential and small multifamily, 4-6 unit buildings, but really distressed stuff, Alan, 50, 60, 70% off what the price was just 2-3 years before. And looking back today, I was like, man, those are the good old days where you couldn't go wrong. You could learn by doing and probably have the tailwinds of the market pricing at you. And today, different story, but we decided to open up our firm and really expand on what we were doing as a family and partnering with each other and allow some other colleagues and friends and coworkers to co-invest alongside us in our deals. I'll pause. I know keep going, but feel free to chime in and let me know if you want to learn more about the previous years. Getting started.
You have gone from single family and small multifamily into larger multifamily deals. You did that by partnering with your father and then expand that network. Fill us in a little bit on that process of growing that network so that you were able to put together funds in order to purchase larger multifamily.
Sure, yeah. The first real, I guess you could say, outreach to others to partner with us and go out and raise capital from investors. We invited people that knew us to our house, to our basement, and gave a good old-fashioned PowerPoint presentation on our business plan of what we were going to do, what kind of returns that the investors could expect and project, the lifetime of the investment, etc. And so we really started, Alan, just by offering investment opportunities to those that already liked us, trusted us, had faith in us. And it wasn't because we had a 30-year track record doing apartment buildings or mobile home parks. It was more just character. They knew that we were going to work hard and be completely transparent and honest with them. And that's how we got started. And it's evolved since then. Referrals, a lot of repeat investors. 10, 11 years later, it takes a while to grow it, but we've done it primarily organically and through relationships. We're very much in a people business here.
We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet, investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolio selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestor also enables other real estate entrepreneurs and syndicators to build and use Avestor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestorinc.com. Avestor, real estate investing made simple.
You built a business that focuses on recession resistance. So fill us in on how you've developed that aspect of the business and what's really important about that and what does it really mean to your passive investors?
Yeah, so I'll start by saying by 2010-11, when we went full-time with our firm, we had held some of our own assets through the recession, right? So some single family, some small multifamily, and some other real estate as well. So we got to see just internally from our small portfolio at the time, how did things do? Did tenants stay and pay? Did the bank come calling for the loan? All the different scenarios that could be. And everything did fine. Generally speaking, we had some reduction in performance, which is expected during the Great Recession, but we didn't sell anything at the wrong time. We sold a lot of it 5, 6, 7 years later and just held through the downturn. And so that's an important part. You don't want to be a seller at the wrong time when the market is not providing you the best price for your property. And so at the same time, I started doing a lot of research, Alan. I went to a lot of networking groups. I met a lot of savvy folks for a period of about 2 years to determine what other asset classes are attractive and how have they done through the last several years at that time, right, through the recession. And it just kept coming back to just a few that were still doing very well. And the first one was mobile home parks. Affordable housing play, of course, a land play. Many of the mobile home parks that we invest in, we own the land, that the residents own their homes. And so there's a very unique structure there. Supply of mobile homes is flat or declining every year. It's very hard to build a new one in an attractive location. Most of the good locations have already been built, and the zoning laws don't necessarily allow for new mobile home parks to be built in attractive spots. So that story, that thesis just always stuck with me, and met some operating partners that had held many mobile home parks through the recession. And it was the most resilient asset class that I could find. Tenants stayed and paid. You actually saw net operating income growth, rental revenue growth, which is very hard to say right during 2008 and 9. Self-storage was another one. Pretty similar story in a sense where it's been resilient. Tenants stayed and paid. You actually saw some increases in property demand for storage when people are moving, and during economic downturns, there's disruption, and that disruption often creates a demand for storage. Some people think it's going to be temporary, of course, but you find that on average, people tend to rent a storage space for a lot longer than you might think, 14 months. And then you got some people that stay 5, 10 years. My father's one, if he's listening. He's had a storage facility for about 8 years. It's pretty common to see that demand still stay strong through tough times. Some apartments as well. If it's, again, affordable housing, typically $700 to $1,200 a month in rent for a 2 to 3 bedroom apartment. We found that asset class, if it's well located, close to transit, close to jobs, and in growing communities, they have also done pretty well, generally speaking. So I went on this just educational networking surge to find other places to invest just myself at the time. I no longer had matching for my 401k because I wasn't working at corporate America anymore. And my retirement dollars were sitting idle, Alan, and stock market had just tanked a few years before, and I'm not a stock investor, so it was hard at the time to feel confident in that strategy, put my money in the public equities, although you look back today and say, well, that would have been a pretty good bet, but you didn't know that then. And so I decided to open up a self-directed IRA account. I moved a portion of my retirement funds into it, and then I invested those passively through some of these other asset classes to diversify my own money. My father did as well, and some of my family members as well. And we got exposure to mobile homes, to self-storage, to larger institutional, commercial, multifamily. And amongst other asset classes too, we've invested in probably about a dozen different asset classes within real estate over the years. And so that's how we got into recession resistance. Nobody knew what was going on back then or what the markets were going to do. And today is interesting because we just had and we still are in the middle of a pretty big recession. The economy has stopped overnight, which nobody in my lifetime has seen before. And we saw this coming a little bit in some sense, not necessarily a pandemic, but in 2018, we created our recession resistant fund, which combined the 3 asset classes I noted: mobile homes, self-storage, and some apartments. With a foresight, Alan, we saw a lot of indicators in the market that, hey, there might be a correction coming. Let's put together an investment vehicle that can have a good likelihood of weathering a storm, continue to perform and persevere, and not become a distressed seller at the wrong time. That's how you lose money, essentially. So we did that. Today, post-COVID, still doing well. We really haven't changed our thesis much, Alan. We continue to focus on cash flow and growth, essentially in that order. We're just being a little more conservative with assumptions, with projections, with our underwriting. If we think in a normal market cycle, it might take 12 to 24 months to lease up some vacant units. Assume it's going to take 50%, double the time. and then see, do the projections still look good? And so with all the uncertainty out there, we're just being more conservative than before. But yeah, and I could talk a lot about recession resistance, something very passionate about, and we work on it every day. So feel free to poke me if you want more.
A lot of people who invest in mobile home parks and self-storage are big on those particular assets. There's a number of things that are attractive about mobile home parks and self-storage. There aren't as many big investors looking into those. It is a good place for smaller investors to find value-add properties that are at the same time cash flowing. Oftentimes, mobile home parks are the last refuge before living under the bridge.
I'll tell you a little bit about the demand, right? Where who's living in them, who needs them, who appreciates them. And you'd be surprised, it's all walks of life, Alan. You're actually seeing a surge of seniors that are retiring that are actually choosing to invest in mobile home communities, acquire a home and live in one. A lot of people on fixed incomes also as well. I will also say that you'd be surprised. Some of them are very nice, and the people have a sense of community. And they might even have an HOA. They might even have carpooling system internally to help people get to places. And so we try and focus on more of the community aspect. It keeps people happy in the neighborhoods that they're living in. It creates, as a business, it creates a lot more longevity, less turnover, that people tend to stay if they're happy there for, I think, the average about 14 years. And the actual home, different stats will show you that they stay even longer. Some stay 40 years in a park, the home itself. Why is that? It's expensive to move a home. It says mobile, but $5,000-$10,000 it could cost you to move it. And so if your lot rent is $400 a month and you own the house, are you going to spend $5,000, $6,000, $7,000, $8,000 to move it if the rent goes up? It might be cost prohibitive. But if you're not happy, that's a different story. You got to balance it out. At the end of the day, you're providing an affordable housing option, but even if it's a higher end housing option and a single family home, an apartment, you have to make your residents happy. You got to listen to them. You got to understand what their concerns are. And if you can address them and solve them, that's how you continue to create a positive environment for people to live in. Yeah, there's a lot of stigma. When I first started investigating the asset class at trailer parks, who lives in that? And you start thinking about all the negative pictures that pop up in your mind with the pit bulls on chain links and trash everywhere and drugs, etc., crime. And sure, there's properties out there that what I just described is exactly what they are, but we tend to stay away from what we call war zones. But there's plenty that are very nice and plenty that are in the middle where you have a little bit more heavy lifting to do. And you might have to do a little bit more turnover in the first couple of years in order to fulfill the greater community's need for affordable housing. And so the demand for affordable housing in the U.S. today is we just continue to see it growing. At a lot of the parks, there's waiting lists, Alan. People are trying to get in. And that's some of the perspective we have learned over the years by being involved. And we open our eyes to both sides of the equation as an investor and as a user, as a resident, and try and meet in the middle where everyone can be happy.
We'll be right back after a word from our sponsor. As an industry-leading, relationship-focused, design-build construction firm, Mosaic Construction has worked in many different asset classes from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer, 773-491-3145, or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn. You have this slogan that people are more important than property. You got into that in terms of the way to keep tenants is to develop a community. Fill us in a little bit more here on what it is that you mean people are more important than property.
Sure. I just mentioned a little bit on the perspective of the resident's view, keeping them happy, listening to them, understanding what they're going through, and trying to accommodate. At the other side of the coin, in the real estate investment world, to operate properties, I think larger institutional quality apartment building, 3, 4, 500 units, Alan, or self-storage facility, 1,000, 2,000 units, mobile home park, maybe it's got 300, 400, 500 lots, that kind of thing. At that scale, you're going to have people that are going to help you along the way, whether it be staff, whether it be an asset manager, a property manager, a landscaper, whatever it is. Those people that are actually helping you operate the business of owning that real estate are critical to the success. And you can take that same concept down to a single family home rental, right? If you don't live in the house, who's going to manage it for you? Is it yourself? Then you're the most important key to the success of that investment. Is it a property manager, a family member? Who is it? Whatever that might be. Even in that simplest example, that person who is the interface on the day-to-day of the property, the tenants, the maintenance crew, paying the bills, etc., is really the one you're relying on for success. And so that part of the slogan, people are more important than the property, is a little bit of a different view than just the residents themselves, but also the people that are operating the property. And like I've said a few times before, you can have the best property in the best part of town, but if you have the wrong people running it, operating it, you could still lose money all the time. You could, that quickly the reputation of that property in the community can go down, and that will steer people away from it. And so people, at the end of the day, for us, we find are more important than the property.
An interesting take. What you're saying is that, well, people are important as people, but it's not only that, but people are important to your profit and successes of your properties. I'm sure you put a lot into maintaining properties, being sure that they are places that people want to live, but your emphasis for longevity in that property is more upon the quality of the people than necessarily the quality of the property. Is that a fair way to put that?
Yeah, quality of the property, it has to be in comparison of its neighbors, to say the least. If it can be nicer, great. The quality of the people that are running the property can affect the quality of the property itself, positively or negatively. You can ignore tenants, you can ignore maintenance requests, you can ignore that dripping faucet, you can do all those things, and that's a choice that the person is making that could have a negative impact on the quality of the property. And they go hand in hand, right? People can improve the quality of a property, and people can make the quality of property much worse. And so at the end of the day, it's up to the people to determine the quality. That's kind of how we look at it. But from a business standpoint too, yeah, if you have great people, they can increase your cash flow. They can increase your revenue and your profits that property or those properties are producing by doing a lot of things, being proactive, reinvesting into the properties, renovating, improving curb appeal, landscaping, adding in social outings for the community, right? Ice cream, Sundays and tacos, and have food trucks come in and do it at no cost. These are kind of events that you can create that increase morale at the property. And the list goes on and on. So it's a bit of an art and a science. Both matter. You got to do the math, of course. At the same time, try and keep a balance of happiness amongst the community.
You've talked about value add as opposed to cash flow. Fill us in on what you're talking about when you're talking about those two components of an investment.
Sure. So part of our recession resistance strategy is to not rely on natural market appreciation. You just buy it, you sit on the property, you do nothing, and it's worth more. I did that years ago, and I see that can change quickly, right? Especially if the assets are correlated to the overall market, like single family was deeply impacted valuation-wise, right? The value of single family homes in 2008 and 9 went down in some markets, like I mentioned, 30, 40, 60% within a short period of time. To compare that with commercial real estate, most commercial real estate is valuated based on the amount of income that it produces, just like a business. And so you want to try and think of it that way, treat it as a business. And so for value add, let's give you examples, or easiest way to understand. If we have a property that's 50% occupied when you buy it, okay, that's probably not doing so well, right? You're going to have to do a lot of heavy lifting to get it to 100% or 90% or whatever the stabilized percent is that you want to achieve. So that we would consider, based on nothing else, but that alone is a heavy value add project. Probably when you buy it, it's not producing positive cash flow. So you're going to want to increase reserves. You're going to want to be patient, but start working quickly to increase occupancy so that it can start producing positive cash flow. So that's what I would say, a little bit more of a heavy value add example. And now a lighter value add might be something that's 80% occupied or 85% occupied. And then you can raise that occupancy 5, 10%, whatever the number is. So that might already produce positive cash flow when you buy it, which is great. Reduces your risk when you acquire the property, but you can hopefully grow it. And so that's adding value, right? You're growing the value of the property. Other ways, apartment buildings, if a lot of the units are outdated, maybe they haven't been renovated in 20 years, right? 30 years. You can come in and spend $5, $10, $15,000 per apartment and rip the kitchen out, put in new cabinets, put in new flooring, put in new fixtures, new lighting, open up a wall, whatever it might be, Alan. You might be able to raise the rent, right? 20, 30, 40, 50%. Depends on how much you're putting in and the local market and how well you bought the property and how low the markets are when you got it. So that's a great example of adding value too. And so we focus on properties that typically are stabilized when we buy them, occupancy wise. So if we buy them and we do nothing to them, Alan, they're going to produce positive cash flow. A few percentage points in the first year, 3 to 5% typically is where we won't go too much lower than that on cash for the first year. But we want to be able to increase the value. We have to have a business plan. We're going to come in from day one and we're going to do X, Y, and Z. We're going to grow revenue. We're going to try and reduce expenses so that what's left over, the net operating income, is increasing over time. And if you do that, and you're able to do that, then you're most likely going to increase the value of your property, regardless of what the market is doing. Generally speaking, right? There's always some exceptions to that, which we can go into, but that's the strategy we like to focus at the property. We consider it to be a light but sound value add plan, not too much heavy lifting because we want the cash flow to start year one, but we also need to have a pretty substantial upside and valuation growth strategy. And by pulling levers, again, increase revenue, reduce expenses, and the net will go up. And that's how we create value and grow it even in uncertain times like today.
We are in some uncertain times. COVID has had an effect on different classes of property more so than on other classes. What is it doing to you and your investments, particularly in mobile home and also your self-storage facilities?
Yeah, so great questions. I'll mention this. In 2020, we did one investment only on purpose. We've been watching, we've been monitoring, we've been analyzing our own portfolio on the macro side of things as well. A lot of our operating partners' portfolios. In March of 2020, nobody knew what was going to happen, Alan. I don't care who you talk to. Oh, yeah, we did this, we did that, we were everything. No, that's not true. Nobody knew. So we were patient and diligent. As we're talking, it's March 2021. So we have 4 quarters of data that we use to determine where to invest going forward. And that's great. We're in a great spot because we learned more by being patient and persevering. So what's happened? I'll say, generally speaking, most residents in our asset classes are staying and paying. Some of the local communities are helping those that have been impacted by COVID, by rental assistance. That isn't something that we projected, right, or anticipated. So I think we got a little lucky there. Let's be honest. Obviously, the government has been helping folks on a massive scale. That's never happened before in this kind of context. And so we got a little lucky there too. If those two things hadn't happened alone, I think you would have seen more distress. But what has happened is there has been literally almost no distress in our asset classes, meaning discount on pricing of the asset from pre-COVID levels. We actually are seeing pricing going up, Alan. What is that? How is that possible? In the wake of the economy shutting down, businesses closing, and the unemployment rate, everyone's been impacted, right? How could these assets continue to be in high demand? It's because investors out there are chasing yield, and they want to find it in a place that is most likely to continue to produce yield. And so if you think about office investors or retail investors that are buying malls and shopping centers, and if you think about lodging, hotel, hospitality, those asset classes have been impacted negatively on a very big scale. And I don't know if and when they'll ever come back to where they were pre-COVID. So a lot of those dollars from the investment industry are looking for somewhere else to invest, right? They may not be that excited about buying an office building in downtown today. They could be in a few years, but right now we're not seeing it. More investors are chasing apartments. A ton of investors are chasing mobile home parks, and just as many in self-storage. And so we've seen the tailwinds increasing through COVID for the demand for our assets from investors. Why is that important? Because that's who we're going to sell it to. there's going to be more of them. There already is more of them today than there was a year ago. And I think that trend is going to continue to grow. So in 3, 5, 7, 10 years, when we're ready to sell some assets, we believe that the buying pool will be greater than it was pre-COVID. That's a trend that's happening very quickly. It's causing pricing to go up. It's causing a lot of things to help continue to allow us to feel confident in what we're doing. At the same time, you look at the resident demand. The demand for affordable housing continues to go up, Alan. And so that's a general part of our thesis across apartments and mobile homes, of course. And again, like I mentioned, we're seeing waiting lists at some of our communities. Not all of them. Nothing's perfect. No asset class is immune to these kinds of changes in the economy. But generally speaking, residents are staying and they're paying. We're seeing occupancy levels over 90% at a lot of our assets. We're seeing collections through COVID over 90% at a lot of our assets. And storage has been also positively impacted. Again, generally speaking, there's always some properties that aren't doing well, depending on location and other different demographics and how they've been operated, et cetera. But in Q3, Q4 2020, Marcus and Millichap noted that the vacancy rate at self-storage, again, across the U.S., is at an all-time low. Okay, that's a very important piece of information to know if you're going to think about investing in storage. It shows you the resilience of that asset class through the latest economic downturn that we're still going through today. And generally speaking, this is why we haven't changed our thesis much, Alan. We stopped, we waited, we watched, we listened in 2020. And today we're seeing a lot of the data and a lot of the reality continue to point that these asset classes are going to remain in high demand for users and from investors. And so we're excited about that today.
Enlightened investors, we'll be right back after this important announcement. I have a big ask that will only take a moment of your time. Ratings and reviews are the lifeblood of our podcast. So to leave a review, iPhone or other Apple iOS device users, go to Apple Podcasts or iTunes. For all you non-Apple device users, go to podchasers.com. On either platform, search for Real Estate Investing Abundance. Once found, please leave a review and a rating. Subscriptions are also vital to our show's success, so please be sure to subscribe on your favorite podcast app. It is free to subscribe, and you can unsubscribe at any time. Mark, before we go into our last segment, you have a valuable piece of information for our viewers and listeners, Navigating Real Estate, 5 Steps to Reduce Risk Post-COVID. Share with our viewers and listeners how they can obtain that and how they can get in touch with you.
Sure. Yeah. Thanks, Alan. So our website's probably the best way to get in touch. You can go to smkcap.com. Our company name is SMK Capital Management. We've got a lot of information on there, Alan, posts and videos. I enjoy educating folks. It's something I like to do. I used to teach a class at a local community college on real estate investing that was pre-COVID, not doing it at the moment. We'll see if we get back to it. But lots of information there, and you can check out our website. And the five-step download you're noting is accessible through the URL. If you're able to give it to folks, great. If not, they can just email us on our website. Our email address is there, and ask for it. Or if they can get the URL directly and download it, that works as well too.
We'll have the URL in our show notes. Share with us one of your most difficult setbacks in life, and how did you come through that time, and what did you learn from that experience?
Yeah, sure. Let's think here. So I'll say this too. I think a setback can also be viewed as a turning point, and fall down, but get back up and learn from it. And so that's my thought process is you can always point to the negative on things, but they take a little bit more effort, I think, to point to the positive and to focus on it. And so it reminds me of a time during the recession, Alan, when the company I was with, I mentioned logistics and distribution business, was not doing well. Revenue was going from 5 million to about 100 million and then back down to 5 million. That back down to 5 million was over a period of about a year. So it happened pretty quick. And so being that, it was it was very difficult. And not just for me, but for the company and for the industry. And so a lot of people were suffering, of course. And so I came out of that in 2009, really not knowing what to do with my career. And I think just to open up and be a little more personal about it, I was single at the time, living with some roommates. I had just torn my ACL in my knee. I'm now technically jobless, injured, and my girlfriend had just broken up with me at the time. So I had three all within 6 months or so. So I remember just being pretty bummed out, Alan, trying to see what is going on in my life. What should I do? Sitting on the couch while my roommates were at work and with my knee in a brace alone, trying to figure out where to go next. And so that was a turning point. It was tough. There was a couple months there of reflection and adjustment. And so I think that was a tough time for me through my career and personally. And I persevered through it by just, you got to keep your head up. You got to keep trying. You got to keep going. Figure out what gets you excited. Why are you waking up in the morning? What is that about? What is about something about that day that you can feel good about, and focus on that. And that took some time for me to do that. I was largely focusing on the negative at the time. And so I just focused on what I liked, which at the time was real estate and obviously still is today, and thought about how can I do more of what I want. And now I look back at it and I say, I'm glad that those events occurred, as painful as they were emotionally and physically at the time. If they hadn't occurred, who knows where I would have been today? Maybe I'd still be working in corporate America and I wouldn't have been pushed to go and do something a little bit more that I was passionate about and become more entrepreneurial. And I hope that's a good example. It's definitely something that I remember today. And again, just sitting back on that couch, my leg up in a brace and pain and alone, it feels like it was yesterday, but that's part of the process, part of the career path and the growth and getting through it and reflecting and learning from it and becoming a bit stronger. I think looking back today, that's how I feel that the process evolved.
Many of my guests, when they answer that question, they go, was like the worst day of my life, but as I look back, it was the best day. It is easy to stay in our comfort zones, and we oftentimes need a push to get out. Today, what are you most grateful for in your life?
Yeah, my family, my wife, my children. We've got two young kids. They're 4 and 2. And we're in the thick of it, as people tell me. I don't know anything else at the moment, but yeah, they're a blessing. And I will say, again, trying to focus on the positive, Alan. COVID has been tough for everybody. A lot of people have been severely impacted. A lot of lives have been lost. One of the positives for us is with children this young, and we're able to actually see them more frequently through COVID because you just can't really go anywhere. We haven't been. I know a lot of people have, and that's personal choice. And so we've been able to spend a lot of time with our kids, and at an age where I think that you're just not going to get it again. 2-year-olds are, man, they change every day, Alan. And so being part of that cycle of their lives, their growth, walking, talking, et cetera, quite fortunate and appreciative of being more involved during these early years. And got a lot of videos from it. So we're going to use them against them later. Yeah.
Share with us 3 good things from the last 24 hours.
Last 24 hours. I don't know if anyone's ever asked me that before. I like that question. Okay. I went mountain biking this morning. It was 50 degrees. I'm located in Central Oregon, and the weather can be a challenge, to say the least. But I got out, sunny, new bike, and got about a 35-minute ride in, and I didn't fall, and so I had a lot of fun, and it was great. So that's one thing I appreciated in the last 24 hours. Let's see, my son slept through the whole night without waking us up. That's a big one, something we're paying very close attention to, and therefore I did as well. And I think that's 3, but that's what we got right now. More personal stuff than anything else, yeah.
Well, that's what it's all about. Yeah, I asked this question because it is so easy for us to go to bed each and every night reminiscing about what didn't go in the day. And it's amazing how powerful it is if we reverse that and place our focus upon what went. And we can't neglect what goes wrong. We're going to have to address that. But if we focus upon the negative, that's what we're going to be, is the negative. So that's why I asked that question.
No, I appreciate it. Spot on.
Yeah.
It's very important, especially if you're an entrepreneur. It's key.
Exactly. How are you putting your success as an investor and entrepreneur to work to create a universal well-being and abundance for all beings?
Yeah, it's probably something I should work more on, to be honest with you, Alan. I think for me, the first thing that comes to mind is teaching, giving back time, which is, in my opinion, the most valuable thing that we all have, an unlimited resource. And giving some of that up is one way of giving back to folks. And for me and our investors, a business answer, keeping their best interests always in mind and making decisions based on their best interests first. That is important, very important in the world that we're in, the work that we do. And it's it can be easy for folks to deviate from that. And so being disciplined and always having their interests first and allowing them to continue to persevere, I think is a great way of giving back to us in a business sense for those that are working with us. But other than that, yeah, if you have some suggestions, I'm open to trying other things and other ways and new strategies to give back as well. And love to hear from you. Maybe I'll ask you the same question if you're okay with that, Alan. More of a personal interest. I'm curious to hear what you say as well.
First of all, you already mentioned some things that you are doing. Providing aesthetic and comfortable, affordable housing is no small thing. You mentioned the importance of people over property. And so your business, even though it is a for-profit business, you are running it in a way that is benefiting the well-being people. But what do? I think it's important when we are looking at the well-being of other beings that we're doing it from a perspective of what is fulfilling and meaningful to us. I appreciate you asking this question. Nobody has asked me that on this show, but I'm happy to share. I have been working for the last many years upon developing my skills of communicating with other beings, other species on our planet, and in particular, horses. I learned a great deal about the horse industry and the horrific treatment of horses throughout the centuries. But even in today's world, when we look at horses as a recreational outlet for us as humans, we forget what it is that we are actually doing to horses. People ask, what is your big why? My big why is to be able to contribute more to aspects of understanding the equine from the equine perspective. Thanks for asking that question.
Yeah, no, that's very exciting, Alan. It's good to hear that you have a passion outside of the office. Some people these days don't, and I get it. But at the same time, if you can find something that makes you happy outside of work and dive into it, and you can help others, and in this case, help other species, I'm all for it. I think that's fascinating.
Our last question is, when you leave this world, what do you want as your epitaph? And epitaph is, you can look at that euphemistically for not just what you want on your gravestone, but how do you want to be remembered?
Yeah, first thing that comes to mind is an honest person and somebody that is trustworthy, of very high character and integrity. And I want to be remembered and those things first. People think about me as I pass, I'm gone. High quality, high character. Those are the most important to me at this point.
Wonderful way to leave this world. I hope you have a long and prosperous life. Mark, I have truly enjoyed our conversation today, and it has truly been enlightening for our listeners, and I'm sure they have gotten a great deal out of it as well. Thanks so much for being on the show, Mark.
It's been a pleasure, Dr. Allen. Thank you again for having me.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.